Hi guys, welcome back to the channel. I am Dilip. If you are a trader, you have probably encountered sudden price spikes in intraday. But what really causes these spikes? In this video, we will dive deep into the factors behind these sudden price movements with a special focus on intraday price manipulations. There are many reasons for price spike, and to keep the things very simple, we can broadly divide them into two categories. One is news driven, second is liquidity driven. When it comes to news driven economic data of a company or a country, examples GDP, CPI, interest rates, etc., they drive the price moves. Any unexpected news creates an opportunity and markets adjust quickly to reflect this in new information. Large traders rush to take advantage, causing sharp price movements. Coming to second one, we have liquidity driven inventory rebalancing, forced position re-unwinding like short covering, hedging activities, etc. They all come under these liquidity driven price spikes. So here in this video we'll try to focus mainly on the liquidity driven, which are mostly intraday. First, let's look at inventory rebalancing. Whenever we speak of inventory rebalancing, we need to understand who have these inventories. Market makers who make money by making bid and ask price have these inventory levels of any stocks. This is the main reason why most of the spikes happen in intraday. The reason is, if you look at Indian markets, 50 to 60% of volumes we see in the intraday, it's because of this market making process. This market making is price neutral, so even if the prices doesn't go anywhere, these market makers, they just can make money. So let's understand why this happens. To understand why this rebalancing happens, we need to first understand how a market maker make money. The moment you want to buy some share at 99 rupees, you enter the 99 price in the order terminal, and if you place it, it will go and sit at the buy orders. You want 30 quantity at 99 price, and this is the order one. Best buyer available at 99 rupees. 100 is the last traded price, and below you there was another buyer who want 40 quantity and at 98 rupees, and below that buyer there is a person who want to buy 50 quantity at 97 rupees. So you need to understand here, as the prices goes down, more number of buyers will come in, and same like here, there was a seller who wants to sell at 101 rupees, not lesser than that, and the best seller is available at 101. He wants to sell at 30 quantity. This is the order one, and above him there was a seller who want to sell 40 quantity at 102 price, and another seller above him at 103 50 quantity, and these are the limit orders. So unless a market order gets executed either at this bid price or at this ask price, the LTP remains same. So what happens here is, let's say a buyer comes in, a market buyer mainly, who wants to buy at whatever the price that is available. So the moment he places a market order in that order terminal, there won't be any mentioning of any price because it's a market order. So the moment he places it, it will go and execute at 101 rupees. Another, the seller comes and he places a market order, it will go and execute at 99 rupees. So this is in ideal scenario, this is how it happens. So last traded price will be changing to 101, and then immediately it might change to 99 rupees. So let's assume here, first scenario, a market maker comes into the market and he places, he front runs your orders. So suppose a normal retail trader have placed a 98 rupees order, but above you, he placed, this market maker placed a 99 quantity order. So he places it for 30 quantity. At the same time, simultaneously, he places another 30 quantity at 101. So he is selling at higher prices, he is buying at 99 rupees. So assume here, if this both orders 99 and 101 gets executed 30 quantity, it is as good as he is buying at 99 rupees and selling at 101 rupees. So whatever the difference between this 99 and 101, it is called as market maker spread or bid ask spread. So there is a 2 rupees profit for him. So because it's a 30 quantity, he will be earning 60 rupees for this transaction alone. Now if he places 10 such orders, there will be 60 into 10 orders, so it will be 600 rupees he is earning for 10 such orders. The first scenario we are assuming here is the market stays flat, prices is not going anywhere. Now let's take another scenario, market goes up. So here what happens, he had placed the same orders, 30 quantity at 99 and 30 quantity at 101. His orders at the 30 quantity will be filled totally, and the buy order whatever he has placed, it will be partially executed. This is what happens whenever the market starts going upside. When the prices goes down, opposite happens. The buy order he had kept at 99, it gets executed fully, and the order he kept at 101, it gets executed partially, because there are more market sell orders coming in than the market buy orders that are getting executed at this 101 price. So we are assuming here market goes up. So in this case what happens, all this 30 quantity at 101 gets executed, but at 99 only 20 buy side executed. So what happens here, there is a imbalance of 10. So he had sold 10 extra, that becomes his inventory imbalance. Here in this case, because only 20 orders got executed, he is going to profit only 20 into 240 rupees. Let's say in this second scenario, this market maker placed 10 such orders, 40 into 10 orders, it will be 400 rupees, and he had oversold 100 extra quantity. So market maker needs to buy back this 100 quantity to bring back to his initial inventory level, which is 30, causing spike. To manage the inventory levels to his initial levels, he uses multiple ways. So one way most commonly used by these market makers is that there is a formula called stall formula, and they use this formula. Now let's understand in what way we can efficiently track these spikes, and whether the spike is because of any inventory rebalancing, or is it a genuine one. We will try to understand using order flow. So order flow helps a lot, because you are directly looking at the orders that are coming into the market. It can help you to much extent. I'm taking this example, 8th January. So from morning there was a downtrend all the way down to 12:15 candle with a low made at 23,594, and there was a sudden opposite move. So how you could have avoided by using order flow here is, if you observe in the first 30 minutes, yes, there has good volumes and the delta of 1.3k. So this is the first thing, that's saying that aggressive buyers are here, but at the same time they are not taking control, because the candle itself has closed below them. So what happens, as the prices goes down, they will try to re-enter. So this doesn't indicate any kind of spike or anything, but as the prices goes down, these aggressive buyers might re-enter at some point of time. So again, what happened at 10:15, there is again a IB low breaking, and then prices started going down. Now here if you observe, the down move itself is because of aggressive sellers. On right side there is no orders matching equal to left side. So here 1.2, 1.3, that is okay. 1.2, 770, 1.3, 563, 1.8, 53, 1k 7, 42, 413, 1.6, 267. So there is a strong mismatch between left orders and right side orders. So this says that the down move itself is being forced by strong sellers. Once these sellers, whoever are selling on the left side, if they are out of the market, markets will turn around. So this is again a strong sign. So again, the prices came down at 12:15 candle, it closed above the cot. Not only that, there is a strong divergence, and you have in 12:45 candle prices closing above the strong buyer here, 29,160, and prices closing above that indicates buyers are trying to take control. Once the high is broken, there is a good possibility prices will go upside. This up move, whatever it is there, it is again not a very much reliable one. So why is that? If you can identify, like I said here, left side it's sellers forcing downside move, and at the same time here right side buyers are forcing it upside. So not equal volumes here. 1.2k 47, 444 87, 140 918 92, 280 244 here also. So there is a strong mismatch from right side orders to left side orders. And then what happened, you have there is one more higher high, same thing happened. So aggressive buying was there, 796, 326, 543. Here it is okay, 1.3k, 0. So here also not much of left side orders matching to the right side orders, that indicated again. So it's purely because of some aggressive people forcing it. Somewhere in 215 the higher high has been made, but if you look at the price is continuously closing below the big volumes here, here, here. This indicated some passive people are absorbing the buy orders here, and with the gaps here there is a good possibility prices might turn around, which happened on the very next day. Now the other thing we need to understand here in spikes is that forced position unwinding, which is nothing but short covering and long unwinding. What happens here is that guys, people would have shorted, and most of the shorts it will be big institutionals. Along with these big institutionals, retail traders also will be there. And the difference between these retail traders and big institutional traders are, big institutionals, they take the trade and they force the market downside with their selling in cash market or futures market, whereas a retail trader, they just look at the technical charts and they take the position, they hope for the best, and they keep the stop losses at some level. So what happens, these big traders are called as strong hands, and the weak trader, the retail traders, are called as weak hands, because these people are, they don't have any kind of backup. So at some point what happened, as the prices goes down at lower levels, more number of buyers come in. So these buyers, when they buy too much quantity, they want to take profit. So at this point what happens, the buyers have, just like the big institutions, these buyers also will have their stakes, and they try to push the market to take profits in the opposite direction, because the retail traders who have sold here, they may not have the cash backup to force the market downside, so they start unwinding. So this is with the short covering. Same thing happens in long unwinding also. Some people would have bought it strongly at higher prices, retail traders might be there, and they may not have the support. And what happens, once the sellers absorb from these buyers, the retail traders, they don't have any kind of backup in cash market or anything to push the prices upside. So once these retail traders start panicking, there will be a strong down move. Next we have hedging interest. Again, it's as simple as we discussed in the previous short covering and long one. Let's say I'm a trader. So what I do is I sell calls or puts. Let's assume XYZ stock is trading at 100 rupees. So for a premium of 10 rupees, 100 rupees calls I have sold. If the prices goes below, I'll make money. If the prices goes above 110 rupees, I'll make loss, because I have collected a premium of 10 rupees for 100 rupee call. So what I do, if the prices starts going up, I try to sell in cash market, because my stakes are very high around these levels. So I'll sell in cash market so that the prices doesn't go above this 100 or 210 levels. This you can see clearly on weekly expiries or on monthly expiries also. People will be artificially holding some those levels, those round numbers where the price strike changes. So this is one of the main reason. I hope I have added some value to your trading. Don't forget to subscribe, guys, and if you are keen on learning order flow and market profile concepts, you can go through the playlist which I'm attaching at the end of this video. Thank you. Have a nice day, guys.